Last April, 447 stocks collapsed into a downtrend in a single week. Portfolios got destroyed, stops got blown out, and the VIX, it gave you exactly 1 day worth of warning. But there was a clear signal, a signal that started flashing 20 days earlier. The signal was not from the VIX, the signal was not from any indicator on your chart. The signal came from the breadth underneath the actual VIX. Right now, the VIX is sitting at nearly 20. That is the long-term average. Most traders see that and I think they default to thinking this is a normal market condition. Nothing to see here. But the real question you need to be asking yourself is what's underneath that number. Right now, for example, there's 200 stocks that are losing momentum as we speak. 72 are already in free fall, 113 are in transition. It's not a normal market. It's a market making a decision, and the VIX is lying to you. It's giving you stagnated data. In this video, I'll show you a better alternative, one that you can use yourself inside of your Thinkorswim charts that gives you much better information of the breadth of the market so you never get caught off guard again. Now let's start first with understanding what the VIX is. Most traders learn about the VIX early in their trading journey. If you're not familiar with the VIX, it measures expected S&P 500 volatility over 30 days. When fear rises, the VIX rises. When fear falls, the VIX falls. It's very simple. But there is one key problem here. That is, the VIX is calculated from the S&P 500 option premiums. It is a single blended number representing the entire market, and that's where I think this system breaks down. If you think about it this way, if half of the market is panicking and the other half is rallying, what would the VIX read if you were to balance that out? Normal. It averages out this chaos, it looks into the number, and it projects calm. We built something to solve this instead, and that's what I'm going to share in this video. Inside of our Volatility Box platform, we track 609 symbols every single day through our Market Pulse system. Instead of one number, we're classifying every symbol into 4 different market stages. Green means a stage of acceleration or strong uptrend. Momentum is rising. Yellow means the trend is weakening. Momentum is fading. Orange means the trend is transitioning. Caution is warranted right now. And finally, you have red, which means downtrend. Selling pressure is very dominant, and you want to be a little bit more on the sidelines if you're long. When you see the distribution of these 609 symbols across the 4 colors, you're seeing what the VIX cannot show you. You're seeing the actual shape of the market. Let me show you what I mean with some real data. Now again, I told you we're using the past year's worth of data here, so that's the distribution data. And let's walk through what happened earlier this year. And pay close attention to the timeline because this is where I think the market pulse separates itself from everything else. In early February 2025, the market looked fairly healthy. You had 282 symbols in this stage of green acceleration, meaning stocks were just rising up, momentum was on their side. 116 stocks were in a market stage of deceleration, red. Again, a normal distribution. Then came March 3rd. On March 3rd, the number of stocks in this stage of acceleration dropped from 282 down to 157. The number of bearish stocks jumped from 116 up to 224. Now that's a very clear move that's easy for you to see if you are paying attention. The same time though, if you look at the VIX was still sitting in the low 20s. No alarm, no spike, no clue that a lot of this movement has changed underneath the sublevel of the market. Now, over the next 10 trading days after, the breadth quietly deteriorated. Every single day, red market pulse, the stocks in the red market pulse climbed. March 4th, you had 268 stocks. March 6th, 289 stocks. March 10th, 303 stocks. March 11th, 312 stocks. By March 13th, red had reached 329 stocks in terms of the market breadth. That is 54% of the entire universe in downtrend. More than half of the market was already falling, and still the VIX had yet to react. Let me say that one more time, just so I think this concept really gets hammered down. For 20 days straight, the market pulse was flashing an increasingly urgent warning with the number of stocks transitioning to this market stage of deceleration, which just kept climbing, and the number of stocks in the acceleration market stage kept dropping. And during this entire period, the VIX just sat there, calm, telling everyone that nothing was wrong. Then came the brief head fake. Around March 24th, the yellow, or rather stocks in the yellow market pulse stage, surged to 218. This looked like just a short bounce. It looked like the selling pressure was starting to stabilize. But here's the detail that mattered. If you focus on the number of stocks that transitioned to acceleration in this bounce, aka the color of green, that never truly recovered. It still stuck around that same 106 number. The yellow symbols were not transitioning to this market stage of acceleration. Rather, they were staying in this cautionary tail, more flirting with the bearish side. Then came March 28th. Now you have the number of stocks which are hitting the distribution market stage, which is the orange market pulse, at 199. The transition symbols are now collapsing more to the selling side, just like we alluded. And then finally, you have April 3rd. The stocks in the red market pulse explode from 210 to 303 in a single day. If you think about that, that's more than what, 93 stocks that just switched market trends in a single day. So the next day after that, April 4th, the VIX finally spiked. So if you take a look at what happened until then versus when the VIX gave you the signal, hopefully you see a very clear lag in that signal. When the rest of the market finally noticed what the market pulse has been showing us for weeks, it was a little late in my opinion. By April 7th, the number of stocks that were in this bearish market pulse had peaked at about 447 out of the 609 that we studied. 73% of the entire universe was in this downtrend. The number of stocks in a bullish market pulse, aka green, collapsed to less than 30. And 30 out of 609, very small number that were still trending up. The VIX itself was at its peak, but the story had again already been written 3 weeks prior that you were getting all of these clues in this market breadth that was changing in front of your very eyes. The market pulse gave you more than 20 days worth of warning. The VIX gave you one. Now here's the part that the VIX could never show you on the way back up as well, which is where this market pulse becomes really powerful. On April 9th, the number of stocks that were in this bearish market pulse deceleration stage dropped by 65 symbols. So if you remember, the previous drop was 93. Now we're talking about 65 symbols going from red to a little bit more of that orange or yellow market pulse stage. While the market was not recovering, I don't think you saw that happening in green. SPY was still beaten down. This started to give you that first little clue that, hey, 65 symbols have stopped falling. Maybe, just maybe, the selling has subsided. Now, if you keep playing out this timeline, by April 24th, yellow, or the number of stocks that were in this yellow market pulse, which is again accumulation, so money starting to enter, had exploded right back up to 288. And by April 29th, it peaked at 334 stocks. So more than half the market was now in this transition. The VIX was coming down, but again, the breath told you much earlier, 2 weeks earlier, again, that the worst of this selling pressure was over. Then you had May 8th, where the number of stocks that were in this market pulse of acceleration, so the green market pulse, that now surged by 86 in a single day to hit 261. That confirmed the recovery, not by the VIX falling back to 15, but more by the breadth of the actual stocks entering this uptrend, suggesting that the fear has been removed from the market. This pattern repeats itself. The breadth shifts before the VIX moves. On the way down, the market pulse warned you for 20 days before the spike. On the way up, it showed stabilization 2 weeks before the VIX confirmed the bottom. The distribution tells you what is happening. The VIX only tells you or confirms what has already happened. Now I want to show you what I think is the most underrated signal in this entire data set. And it's not the number of stocks, the red count in deceleration, but rather the number I think you want to focus on is the number of stocks in this yellow market pulse stage. That's the accumulation market pulse. Yellow represents symbols in transition. The trend is weakening, momentum is fading, and the stock has not broken down yet, but the strength is leaving. When the yellow number count crosses 250, meaning more than 40% of the universe is in transition, something interesting tends to happen. Within days, you get a resolution one way or the other. Either those yellow symbols break down into orange and red, meaning they've now gone into this market pulse of distribution and deceleration, slipping down to the bearish side, or they recover back to acceleration, aka green. And this is where you need to pay attention because the yellow count also serves as what I would call your trap detector. Remember that March 24th period that we were talking about? Yellow surged to 218 stocks and it looked like a short-term bounce. But the green number stayed flat, the number of stocks that actually transitioned to acceleration. So these yellow symbols, they weren't actually converting back into this market stage of acceleration into trends. They were instead stalling. When yellow is high but that green number is not growing, the resolution is almost always back to the downside, aka it's just a little bounce in what is otherwise the continuation of the downtrend. Compare that to April 29th. That's another data point you have. This time, the number of stocks that were in this market stage of accumulation peaked at 334. But this time, the number of stocks that were also climbing into this acceleration green market pulse were climbing as well. 74 stocks were green and rising. The yellow symbols were transitioning back to strength, not stalling before this breakdown. You have the same high yellow count, but this time a completely different outcome. So the context of other market pulse regimes also gives you some clues around which way this resolution is going to be, whether to the upside or to the downside. Take a look at what happened just 3 weeks ago. On April 8th, the number of stocks that were in this market pulse of yellow, aka accumulation, jumped from 178 to 308 in a single day. 308 symbols shifted to weakening trends simultaneously. The VIX had yet to give you any kind of clues. It wasn't screaming anything of that nature, but half of the market had just lost its momentum. By April 14th, yellow peaked at 312 symbols, and the resolution then came over the next week. The number of stocks in this green market pulse, aka acceleration, surged from 103 to 225. The yellow symbols chose up instead of down. But here's the key. If you're watching only the VIX, you saw just that calm 18 the entire time. You had no idea that 312 symbols were sitting on essentially the edge of a cliff waiting to decide one way or the other. That is the information gap, and inside of that information gap lies a lot of opportunity for profit. Now, what does this breadth tell you? How can you use this as a conviction filter? The breadth tells you what's happening underneath the market, but in order to trade it, you need to combine that with some other clues. And I think that's where the volatility box levels give you a very concrete edge. We calculate key price levels for every single symbol. And if you take a look at where the volatility box models give you some sort of clue, you'll see that we have the clouds, which are closer to where current price might be trading. You then have the outer edge of the clouds where you might have higher conviction entries. And then you have what you would call your stretch trades with the conservative volatility box waiting for price to really fall if you're looking to go long. Now here's the data that helps connect this to the volatility box models. During that fear period from March 20th through April 7th, when the number of stocks inside of that red market pulse was above 275, the conservative volatility box models had a significantly higher completion rate than even the L4 level. So essentially taking the entry whenever price fell into our conservative volatility box models instead of trying to get greedy and wait for the edge of the clouds was a much better idea. So what is that telling you? It's telling you that conservative volatility box models, whenever you are starting to see these price gaps and entering at the clouds is a really nice strategy that helps outperform some of the aggressive models. So when this breadth is shifting, aka yellow is surging or red is peaking, the setups that come closest to the conservative models are the ones you want to pay attention to. They have the highest probability entries during this transition period. When you're not in this transition period, you'll find the inverse. So, for example, when you are in this period where VIX is, or not VIX rather, but the market breadth is relatively calm, you'll find the aggressive volatility box models are actually much better because you don't see price gravitating to the conservative. So all of a sudden, you're able to use this market stage and the underlying market breadth to help figure out which volatility models you want to be deploying in order to maximize the type of entries for that particular market condition. So now this brings us to the next stage, which is putting together a framework that works for you and your trading style using all of this data, because what works for me doesn't necessarily work for you. So step one, I think, across the board would be stop looking at the VIX in isolation. You should also be looking at the market breadth. I like to do this with the market pulse distribution. How many symbols are in green versus red? You can get this count very easily inside of our volatility box dashboard. You'll be able to see what is the market breadth, how many stocks are green versus red, what's the yellow count, what's the count of the number of stocks in the orange distribution level. You can start to see how this is transitioning over time. Pay attention to this number to see when do you have some of these spikes. So that takes us to step two. Watch for these yellow surges. If you have to choose just one, yellow surges are the ones to pay attention to. When yellow crosses this 250 threshold, that's when you want to see what's happening here. Do we have stocks agreeing in the green market pulse? Is that rising alongside, or is that number staying flat? That gives you your next clue, which takes you to step three. During elevated red counts, you want to be using the conservative volatility box models for your entry. These are your highest conviction setups when the market is stressed. Step 4. During the green dominant markets, be aware that the breadth can look healthy while the individual sectors might show you some more opportunities. So in those sectors, you may want to still be using conservative models, but in the stronger sectors, the aggressive models are completely open for you to be able to be using. So check these divergences and use that to help pick which volatility box model you want to use to go either long or short in the direction of the trend. And we have filters built inside of the scanner, plus new ones I released to make it really easy to do just that. So I hope through this video you learned some key distinctions or some key points that I think help correct your understanding of the VIX. First off, looking at the VIX inside of its own little funnel, its own silo, is a mistake. The VIX is not wrong, it's just incomplete. It gives you some data, but I hope I proved how the VIX can show that it's just calm while there's a lot happening underneath the market. The market pulse and the market pulse breadth rather gives you much better clues of how to make sense of what's happening in the market, gives you better clues of being prepared for what's to come in the market, and you might use the VIX to confirm the understanding of what you've been assumed to be building up. If you remember when we looked at April, we saw that the market pulse had shown that this April crash had been building up for 20 days before the VIX actually reacted, which was just a 1 to 2 day event. Even for the recovery, it showed that the recovery was stabilizing 2 weeks before the VIX actually confirmed the bottom. And it showed the difference between a real bounce and the head fake by tracking how these yellow symbols, the number of stocks in the accumulation market pulse, actually resolve. If you want to see the full distribution in real time, again, you can find that inside of the Volatility Box platform and inside of the Opening Range Breakout platform. Both dashboards contain this data. I think it's the core of everything we do here at TOS Indicators across all of the different software we build. Stop watching just one number and start watching what is underneath that number. Hope this video was helpful, and I'll see you in our next update.